Groupon is building the daily habit in local commerce, offering a vast mobile and online marketplace, connecting online buyers to merchants, and allowing them to save on amazing things to do, see, eat, and buy. Groupon is now operating in 26 countries and over 500 markets worldwide, with 50 million active customers and 1 million merchants, supported by a workforce of more than 8,000 employees worldwide. Groupon is not anymore an email deal company. Groupon is aware that more and more people conduct business with the smartphone in their pocket. It is nowadays mostly a mobile business, accounting for 60% of Groupon's transactions worldwide.
Gross billings, which represent the total value of customer purchases, decreased 3.8% in the first half of 2016 compared to the same period last year. This is mainly due to the international markets, where Groupon exited operations in 19 countries in the last 12 months. If we look only to North America, gross billings increased 8%, while EMEA declined 12% and the rest of the world 27%. Marketing expenses increased 61% in first half of 2016 comparing to the same period last year. It represents 24% of operating costs, with a total expense of $182 million. As a result of the marketing investments and initiatives, we see an accelerated customer growth in Q2 of 1.1 million additional active customers only in North America. In 2016, Groupon incurred in $28 million expenses in restructuring charges for closing entities and streamline operations. Groupon, as a global organization, is using their international setup to deliver efficiencies that will ultimately lead to long-term business growth and success. When we look at their balance sheet, we see the assets are mostly leveraged by current liabilities. Groupon has almost no debt, and the main liabilities are accrued expenses. Their assets are mainly represented by cash, almost at 50%. For the first time, 2015 showed a positive ROA of 1%. After several years of negative results, finally Groupon is giving positive news to their investors. 2015 data shows a 3% positive ROA reflected by a good expenditure control managed by the company and a reduction in equity. Groupon repurchased $600 million in stocks last year, a massive operation generating confidence in the investors. For this, they used cash and not debt, impacting negatively their working capital, which was negative for the first time in 5 years. Their balance sheet and cash flow is reflecting a company with sufficient cash to run their operations. However, with their expansion plans, they need to start leveraging these plans with debt and not with current cash, as this seems to start impacting their working capital.
Groupon's future value is strongly linked to its recent past. The recent restructuring has made the company much leaner and more profitable. Groupon is continuing to refine inventory management, shipping, and processing to generate further cost reductions. Groupon continues to aggressively invest to support new growth from acquisitions, expand their product range, and to develop a new technology. Groupon's innovations are juicing their growth of market share and of share of wallet. The mobile platform has quickly become a key value driver for Groupon. The weaker euro and plunge in the pound negatively impacted 2016 figures and are likely to damage earnings until the full fallout of Brexit are felt. However, the US dollar is expected to continue to gain in strength, and overall value will be buffered by a stronger US dollar.